Well, everything we've been kind of waiting for this week has really come out last night and then today and then the after hours here. Really busy couple of days. So we're going to take a look at the aftermath of this Fed meeting. And interestingly enough, with all this activity, finishing with pretty much an inside day on the S&P 500. So we're going to take a look at what kind of trends we're seeing in these indicators, whether it's a converging trend on the S&P 500 or the potential for a breakout move on the Russell. So we're going to take a look at that. How does that affect our expectations? For that matter, on the Russell going into tomorrow, how does that affect what we see going into the end of this week and into next week? And what kind of inflection point may we have there, and what might it lead to with what we're seeing in terms of this grinding action we're seeing in the S&P and the Qs? Can we get another round of risk appetite here, essentially? So we're going to talk about that, including other asset classes, taking a look at other asset classes, and an interesting sector rotation that's going on right now. So we're going to break that down as well. And then our trade idea as a stock, using a strategy that's been pretty popular here in these videos here lately because of the type of market we're in. We're going to take a look, use that strategy again with a stock that's a kind of a good picture-perfect example of employing that strategy. So let's go ahead and get started. Today is Wednesday, July the 28th, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see here, we still maintain, even with a 2-day losing streak. I mean, that's what a 2-day losing streak looks like in this kind of market. The intermediate posture is still strongly bullish. The market sentiment line's back above 80, so that's strongly bullish. The near-term line's down below 60, but not, still hasn't dropped below 50, much less into the bearish territory to end this current near-term rally. So it's actually still doing pretty good. You can see here the near-term rallies, how long that one lasts. Here's another near-term rally there. There's a near-term rally. So we're on one right now. The momentum line is not really showing any bullishness, but you notice it didn't go down either. We're off of yesterday's low point with an inside day today. Actually brought the momentum line up from the lower half of the chart. So still a strongly bullish trend, strong bullish there on the Dow Jones. In fact, this is a very strong bullish pattern on the Dow Jones Industrial Average. You have a bullish posture, you have an oversold momentum line, and then you have the near-term line dipping in the lower half of the chart. So that combination of those three things, the bullish intermediate confirmation signal, that's a bullish pattern, right? That's an opportunity for us to really bounce up from here. So again, take that for what it's worth. I'm not looking for like a breakout move here, but at least buy the dip opportunity, which the market seems to really love these days. You also take a look at the NASDAQ. Again, just like the S&P, it's down below 60, but not into the lower half of the chart yet, or below 40. Strong bullish posture on the market sentiment line and the intermediate line, both of them rising. Momentum line rising again, too, back into the upper half of the chart. So a good opportunity here for the NASDAQ. And then the opposite, right? We had a good day on the Russell today, but we still have dark pink shading and a red line. We still have the intermediate line falling below 50 and close to dropping back below 40. The near-term line's not, between 40 and 60. The market sentiment line's between 40 and 60. The momentum line really took off. But you notice again, a little bit of an upper shadow there off of the high. We'll take a look at more of that there. But the market forecast still not nearly as bullish. So still a pretty significant discrepancy between the strong bullish posture that we're getting in the broad market as a whole, as well as the industrials sector, the industrials, Dow Jones Industrials, and the NASDAQ 100. A big segment of the S&P, but not the only segment. And then finally, the bearishness that we're seeing on the Russell 2000, which is a little bit broader because there's a couple thousand stocks in there, though very, very small companies. So it's not, we're not getting bullishness across the board, and that's why, look at the Russell for multiple expiration cycles, continuing to stay in this really sideways trend and not really going much of anywhere. Of course, we know why. We know how bullish that the Russell has been. To get to that point, that rally right there was just insane. To go from the September 24th low all the way up to that closing low, all the way up to the closing high. I mean, it's a 61% gain over a course of 117 trading sessions. Annualized return of 130% if you look up there in the top left and those numbers. That's a significant move in a relatively short amount of time. Very steep angle there on the trend, a 29-degree angle there. So about as bullish as you could possibly be, over that time frame. 172 days, so about a half a year. So that's probably about 6 months, a half a year there. So you've got to consolidate. It's hard to maintain that kind of trend, and this is a consolidation. It's you can see there's been some bullish spurts here. That last little this push higher here, this push higher that almost got you up to new highs. But we've been more sideways to down. In fact, we've had the intermediate line drop below 40 3 times after dipping below 50, or getting to 50 there. The first dip, and then 3 successive dips of getting below 40, getting deeper below 40, and staying longer below 40 each successive time. And also you can see getting higher and getting being more bullish for a little bit longer each successive time as well. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. Number 1, you liked our video today. And number 2, it tells us that you want us to do another video again tomorrow. Quick way to give us feedback if you like our videos. Of course, if you don't like our videos, you don't have to click on anything. But if you do like them and you want to let us know, click that thumbs up. You can do that right now while you're watching. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. All of our free subscribers get a unique offer to check us out, so subscribe to our site to see what that offer is. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. Of course, if you're watching us here on our blog, check out our classes over here on the right, including our Market Outlook live video. This is where I review all the trades that we do in these Market Outlook videos. I also put on today's trade idea before, the one that we do at the end of the video. I've already put it on today before the market close. We did that in that video there. Again, that's done at 3:30 Eastern time. This is where you get to it. You can also get to it up here, live trade review. Also, our upcoming classes that you can see. You can see all the classes by clicking on trading rooms right there. Again, all of our paid subscribers get access, whether you're premium or plus, to our trading rooms and our Market Outlook live videos. Of course, our premium subscribers pay less per month for that access, and in addition to that, they also get access to our class forums as well as all of our premium resources. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also click on this thumbs up icon. Opens up another new tab. Click on that like button right there. Again, the more you do that, it really helps us out. It helps get our content out to all of our followers. You can see the numbers actually just getting smaller and smaller on Facebook. Their algorithms for this kind of stuff is really hard unless it's got engagement. So that's why we ask you for those all the time, whether it's Twitter or Facebook. You can see Twitter got almost 100 last time. It benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. All right, let's get back to our charts and let's take a look at the long-term charts for the S&P. And you can see, again, still maintaining bullishness, very strong, 8% PPO. That's a very, very high number, as you can see, over the last 5 years. And, of course, over the last 20 years, not including the late 90s, right? It's the highest number. This is the most bullish that we've been over the last 20 years, including going into and coming out of the last big bear market that we had. It's very significant, of course. Look at the Russell 2000, and we're continuing to dip, though we are getting more of a transition candle. So we'll see if we can get back up above that 50-day moving average here this week with a green arrow. We're trading near the high of the Hakinyashi. The high is at 2237.04, which is just below that 2243 number. And we're trading at 2225 right now, as you can see up there in the top. Let's take a look at the 3 green arrow chart for the S&P 500. 3 green arrows, though we are starting to lose a little bit of momentum. If you take a look at we're above the 8-day moving average, but you see how the histogram is rolling over, which means that MACD isn't peaking. It's a divergent peak. It's lower highs in the MACD and the stochastics, though both are, the stochastics is well into the reversal zone here. Let me get rid of that line. Well into the reversal zone there, and above their moving averages both. But let's see what happens and whether or not we extend back away from this 8-day moving average, or whether we continue this convergence that we're getting. Of course, IWM is actually still below its 8-day moving average. That bearishness is converging. As you can see, the MACD is actually rising. Stochastics is rising. Those stochastics looks to be slowing down before getting above 60. So we'll see if that ends up playing out into a little bit of a resistance level. The MACD histogram is positive, but we haven't gotten above, we haven't changed the trend yet. Where it's one thing to get positive and you've broken above the 17-day and above the 30-day, and you're able to really get going and change the trend. We've been positive and we haven't been able to change the trend. We're still trading at or below that 17-day moving average there. Let's take a look at some of the other oscillators. For the RSI, you can see the S&P still above 60, and in the higher end of the neutral zone, and it's up above 0 at the very least. On the CCI, RSX or the Russell, not quite the same. It's barely above 0 here, and we're still below 50. So both lines in the lower halves of their charts. So we're just really not getting any kind of bullishness. You have a strong bullish trend going in the S&P, and the opposite is true of the Russell. Now it's not as strong, but you're still below -2. You're still above 65, so you're still below the blue line. You're still below the cloud, so you're still in bearish territory for IWM. You can see you're also still below a major resistance level, like about as big as one as you can possibly get from a volume standpoint. Whereas SPY is still in the upper quartile, though the bandwidth is shrinking, and we're still in the value area, not extending away from it like the Qs, whereas the Qs is up above that value area over there. One last look at the directional movement index, and you can see, again, we're both lines are above 25, so we're not really getting a good trend going one way or the other on SPY. IWM still showing above 30. The positive line's above 25. So this Russell 2000 is actually set up to either break and really get going to the upside, or it's right up against all these different highs or resistance levels on these indicators and price and volume. There's, again, I expect resistance to hold until it doesn't. So I personally expect that things will bounce back down tomorrow, but starting tomorrow on the Russell 2000 at these peaks. But there's also a chance we can break through and maintain and get some bullishness here that we have already been getting on these other indexes, until most likely the Qs themselves kind of get into this parabolic mode. We were kind of working towards some parabolic moves, but even that's kind of ended with that significant peak above 40 on the positive index that happened to coincide with a just below -20, not below 10. We've already had the low on the negative. It's been getting higher lows as we've been getting higher highs here. That might have been about as parabolic of a peak as we're going to get on the NASDAQ. All right, now let's take a look at the intraday move, and you can see here SPY's intraday move. Now here's an interesting development. We talked a little bit about this in my trading room today. If you take a look at where we're at right now, by the time we get to August expiration, to where this day right here is the 420th day on a 20-day range for August expiration. If you come out over here, then that means you can see that would be the 20th. So that means we have 1, 2, 3 weeks, and then this would be week number 4. So the 26th right there would be week number 4. So in other words, all of this, some of these days will be on, this will be on there. This will be day number 1. This day right here will be day number 1 on the 20-day range. So that means anything before this date, all of this will all be off, including that low point. All of this will all be off. So by the time we get to August expiration, either one of two things can happen. either this will be the low point right here for the next 20 days and we'll just grind higher, or this is a very good chance that that's going to be the high point for the next 20 days, and we'll probably maybe get a little higher high, but more than likely get a lower low than that level and move towards, say this 428, 430 to 428 area. Very, very good chance that that's going to happen. So keep that in mind, again, as we move into, again, seasonally bullish time of year for volatility. Let's take a quick look at IWM. IWM is still kind of sitting here, with last week's high point, which is the brown line, sitting as a resistance level. Unable to really get going through there. A couple attempts this week to get through that high. Unable to yet. You can see at least we're above the point of control for the 4 weeks, which is actually below. So there's a good chance we got a higher high and a higher low today, and we finished above yesterday's high point, and we finished near the high of the day, a lot closer to the high than we did the low. So that's a bullish day for the Russell 2000. Compare that to SPY, which had about a slightly higher high and a higher low point, and we finished about in the middle of today's range, which was much smaller. So, and when you look at it from a ES perspective, because of the range, the range of futures, you can see that we actually had an inside day on the futures contract because again the futures trade in the pre-market before you got here. So we actually had a higher high than what we had today on the futures. So that ended up being an inside day, kind of a neutral day. And like I said, finishing below yesterday's high point in the middle of the range, again, goes to show how neutral that actually was for the S&P. Let's take a look at the volume. 52 million shares trading hands. And if you take a look, I need to save this chart so I don't have to do this every single time. If I fit the studies and we use a log scale. There we go. Alright, so if we zoom in, you can see, okay, the volume, 52 million shares trading hands. The range today was less than 3 points, no gap to consider, so less than 3 points there. Let's put that into context. Less than 3 points is below, it's way down here. 3 is the low level of the ATR, so it's off the charts. 52 million is right here too. It's below what we've seen for the past year, except for that little dip going into our only intermediate pullback. And you can see the ATR is still below 1%, still at these lows. So that's rising volume, even though we had a low number. Rising trading range, even though we had a lower number. And for that matter also too, we're down to extreme lows in volatility. But keep in mind, when you look at it from a seasonality standpoint and a closing standpoint, we have a rising trend in volatility heading into a rising time of year for volatility. So rising volatility, rising volumes, rising trading ranges isn't the most bullish, and that's what we happen to be getting right now. And we are seeing, I've told you before, and you're not so much getting it here on the SPY, but if you look at IWM, look at all these down, the 1% or less down moves, and you can see historical volatility is rising. So we are in pullback mode here. Even a 3% rally you don't get during a bullish market. You typically get during a bearish run when you're further below. After 5 consecutive down days and 4 of them more than 1%, you get a 3% rally, and then you start to fluctuate back. And like I said, historical volatility itself is ramping, and lots of gaps, lots of significant gaps here to the downside that you don't get during bull markets, but we have been getting them here lately on the Russell 2000. All right, so before we take a look at different asset classes in addition to equities, and we talk about our trade idea of the day today, just to summarize this technical outlook, we're still grinding to the upside, but we're still in this very strong trend from the broad market perspective, fueled by a very strong trend on the large cap tech names. We're through earnings for now for pretty much all, for the big ones. Now the question is, are we going to hit these kind of resistance levels across multiple indicators, especially on the Russell 2000, and continue lower on what is currently a pullback on the Russell 2000. It's very, very small, but still a pullback by a lot of different measures. Will that extend into the other measures? Are we going to get to where we're breaking that 23% line and kind of opening the floodgates? We might know as early as tomorrow, and I actually expect that we'll probably lean more towards the downside tomorrow based on those technicals, or we'll get the break and we'll be bullish for however much longer. But considering the rising trends and volumes and volatilities and trading ranges, that would suggest that we're headed in that direction. We'll take a look at some other things here too. But what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that tell you why you're either a lot more bullish than I am or why you're a lot more bearish than I am? All right, now let's take a look at these different asset classes and how they're performing. Let's look at how this week has gone here so far this week. And you can see the 3-month returns. It's interesting to see commodities and long-term bonds and real estate and the Qs all up 8% in the last 3 months. And that's insane. Those are not 3 asset classes or 4 asset classes that you would typically lump together. But those are how they're performing. And you can see the weakness in emerging markets led by China, with a really good rally in China today, and as well as the weakness in small cap stocks. If you did take a look at just today, you can see how that weakness reversed itself. So let's take a look here at one just today alone, and you can see emerging markets are up almost 3% right from the get-go. Small cap stocks up 2% at one point in time today before pulling back to a 1.5% gain. Large cap stocks, despite strength in the Qs, we're down today here, and you can see the dollar was down significantly, and bonds were down until the very end of the day. A little bit of a risk-off move heading into the end of the day, with gold and bonds rallying and large and small cap stocks really dropping off like a rock. So if you take a look, we know that China had the biggest selling, and we've talked about that, and we've talked about that quite a bit, and we even talked about it in my class yesterday, I believe, on China. If you take a look, we talked about how China was set up for a bounce, a really significant, strong bounce, and we got that, right? We got that today, 6%. I mean, it was clearly set up for that, and that's what it was yesterday that we talked about that in our trading room. And we bounced right off of that sucker and all the way back up 6%. You can see everything pretty much continuing their recent strength up to these moving averages. So nice little recoveries. But now the question is resistance going to hold? Light green shading and yellow lines here slightly are still red in some of them. Is resistance going to hold, and we're going to roll back over on a lot of these developed markets and other emerging markets? That's, of course, the big question, as they're all diverged away from what we're getting. These are all lower highs that we're at right now, coming off of higher lows, whereas with the S&P, we're getting higher highs and higher lows. Right now. Let's take a look at the charts. Let's take a look at the Euro-US dollar. The Euro-US dollar has been, remember that dollar's been really weak. You notice it's bouncing back up. It's still very bearish, but that near-term line is as strong as it's been during this bearish run. So that's a good opportunity for a little bit of a short-term reversal. At the very least, short-term reversal on this. You can see we're still holding that 78%. We've hit that twice now, a little bit below it last time. But very strong support from a Fibonacci, multiple Fibonacci lines in this area, bouncing up. But as of right now, you can see we're bouncing up towards a resistance, and that moving average as of right now. If you see here, the 23% line in this line here. Let me move this. Let me change this. We'll edit that, and then we'll change this color to something that stands out. So something like maybe blue here. There we go. So now you can see if we do continue to rally, look at where resistance is going to be. We have Fibonacci line here at 118, and probably about 118.80 in that area between these two lines. Maybe a little bit higher up to that 38%, 50%. There's a 23% line. I think that's probably your best case scenario for the euro if we were to get bullish before hitting some resistance. I think as we move towards a risk aversion trade eventually, then we're probably going to stay down in these areas on the dollar before eventually on a new leg of risk appetite we move back up to a strong bullish trend again. But you can see the weakness in the dollar there is just an oversold weakness. The same thing with the weakness in bonds. But even though we came off the lows for the day, and still showing a nice bullish trend in bonds. That's a risk aversion trade. And then gold giving us a yellow line and light green shading, but looking like it might be rolling back up. If you take a look at the 2-line version here for the ETF, you can see the MACD starting to turn up again. We were kind of flirting with that 17-day. We had gotten back below the 17-day, was below it for quite some time, below the 17 and the 30, but then boom, breaking back above both the 8 and the 17-day, the MACD turning up. Stochastics potentially rolling back over from with a phantom green arrow. So this would be bullish for gold. Again, a risk aversion trade if that were to happen. And when we talked about China, here's that China move. Let me zoom out to a little bit longer time frame on here. Here's that China move, and you can see even with a 6% move, you're still below the 8-day moving average. So there's still an opportunity for some bullishness in China coming off these extremes that we saw yesterday that pointed us towards this expectation, this expected move that we ended up getting here. Of course, I'll talk about that more in my portfolio management class tomorrow. That's a big factor into what we're doing in that particular trading room. So that was a welcome sight after some down days, some significant down days the last couple of days. Of course, if there is more risk aversion, that's going to be a temporary bounce, right? And we'll still maintain this divergence, though it seems like we might be peaking pretty soon on that MACD and starting to converge. We might not go up, but we might the big selling might be done, and we might retest these lows, but at a slower pace than what we just saw over the last couple of days. Let's take a look at the sector charts and how they're doing, and let's just take a look at here this week. So bear with me while I get over here, and we'll go to a 5-minute chart. So here's this week's chart, and you can see energy, which has been a big loser here recently, bouncing up to 2.5%. Look at technology is down, so they're the only ones. Like XLY is down 2, down 0.5%. Industrials down along with them. Staples down along with them. So a pretty good representation across all three of these rows in the 12 grid. You have technology and discretionary showing weakness after some strong peaks, some divergent peaks here. Higher highs with lower highs in the different oscillators. Let me show you. In fact, let me show you this chart. This is a relative rotation graph in XLK, and let me go back to a daily chart. So let me update this, and okay, we have to make sure we're at XLK. So here's XLK, and let's just go to 1 year. So there's the weakness, and there's the divergent high points that we're seeing across different indicators. Here is XL. Here, let's go XLK here. There's the divergence with the RSIs and the divergence with the MACD and the CCI as well. So I mean, a divergent high point. Not surprising that we would get one of those. Even QQQ and IW, the ratio chart of QQQ to IWM is also converging now from a really high MACD, so we'll start working its way down towards 0. It doesn't mean we have to go down, but this means we'll start to really significantly slow down on there. Start flirting with the 8-day, start flirting with the 17-day moving average a little bit more. But look at the relative strength line for XLK here. We've got negative momentum. The relative strength is rolling over. You can see the relative strength here is interesting. XLK on an absolute basis is well above this high point that we had in mid-February, but not the relative strength line. We've been really, really sideways on XLK relative. In fact, if you go to that peak there of, what would this be from? The date of that peak would be February the 12th. So if I were to come over here from February the 12th, where is the sector? That one. And go February the 12th till now. Then you can see there's XLK, on an absolute basis doing really well, but you see how it's been lagging behind the S&P the entire time. It's been down below, along with XLY too. It's been down below there, and we've had these good runs on these areas, and they've peaked, right? They peaked in March. They peaked right there, actually, March 15th. They peaked, and they've been kind of doing nothing since. And you see how the move on XLK, what relative strength it did have here lately in this month, is rolling over, and we see that a little bit too in XLY. You can see XLY is way below that February peak in terms of relative strength, even though it's much higher high in an absolute basis. And you can see now too that its relative strength line is actually crossed below 100. So showing some weakness with these divergent highs and relative strength on these major indexes that have been the big winners, right? They've been here in this 12 grid. They've been the big winners. They're starting to roll over, and you can see the light green shading and yellow line of materials. Energy still well below its moving average. Light green shading. Financials and industrials flat at best. And then you can see the safety trades kind of slowing, converging, right? Very strong momentum that now are converging on all of them. So you can see the grind at best. From a risk appetite standpoint, we are grinding. We're not really getting good, solid momentum really in either category, whether it's this large cap tech, whether it's this reopening trade in the middle row, or whether it's even the safety slash inflation trade over here with real estate in the bottom right. And that takes it to our trade idea of the day. And we've been doing a lot of iron condors here lately in this video, and I've got quite a few in my classes. There's a good reason, because this is the type of market, when you look at this chart, this is the type of market that iron condors work best in. You've got this slightly bullish bias, but a grind. And at best, you know, a lot of other stocks are kind of in sideways ranges themselves. And one of those stocks is kind of in one of those sideways ranges with a little bit of a bullish bias, just enough of one not to be on a bearish trend and tanking, is DraftKings. DraftKings had been bearish, has been consolidating that bearish run, and now we're kind of sideways. A little bit of a bullish bias, dark green shading and a green line. You can see we got 3 green arrows here. Not very much volume though to support that green arrow, so it's not really a breakout type move. You don't see breakout signs here either on the DMI, which is still actually pretty negative, or on the RSI and the CCI, which they're up above their midpoints, but they're not really in bullish levels, strong bullish levels. You can see the Ichimoku trend strength indicator is flat. There's no trend. We're actually in the cloud, but we're not bearish anymore. And then you look at the Bollinger Bands, and you can see we are trading in the middle of bands right around this tremendous volume node. So we've been consolidating, and now it looks like we're coiling around the center of gravity, point of control. For the 1 year area. Of course, that sets us up for the type of trade we really like to do. So let's sell the 47 and buy the 43. I'm doing this. I'm selling at that 28 delta. I usually sell right around the 20 delta for iron condors and go out $2-3 maybe. But I'm going out $4 and selling the 28 delta because that's what I have to do on the call side. That's all I've got available to me. So I don't have any deltas lower than 27, 28. And then I have to go out $4 wide. That's the closest strike. So that's why I ended up picking the puts, was to balance myself with the call option as much as I can. So that sets us up here. Let's go to a single symbol. That sets us up for that. There's my break evens, and you can see where my break evens end up looking like here on the chart. Earnings is coming up, so you notice I didn't do a full position size on this. Here, let's go back to DraftKings. I didn't do a full position size, but I was able to get a really, really good return with a small amount of risk anyway. So because of the earnings that's coming up. But as long as we stay here in the middle, then that's okay, right? We'll get some volatility, and we typically do around earnings. But even last time, the last earnings of this particular quarter, we didn't really go anywhere by the time we got to August expiration. So we'll see if that ends up being the case again as we move towards August expiration with this tremendous volume node that we had last time. We were trading sideways here. If I were to go back a year from now, so it would be 728 going into 728.20 from 728.19 going into that earnings cycle into August expiration. You can see, well, we didn't really have a year's worth, but we had that volume in this area there too, and as a result we didn't go anywhere. Once we had that earnings announcement, we still stayed right in that area. So that is what you see here, right? We stayed in that area to August expiration. That's kind of what I expect we'll see again with this current summer earnings report. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. That will, all of our subscribers, even our free subscribers, have access to that forum. So open up any new thread there with any questions or comments you have about anything I talk about in today's video. Reply to anybody else's threads. And let's keep this conversation going among you, the viewers, in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, like us on Twitter and Facebook too, comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.